Hi everybody, Shawn Lucas here, head trader at the Apiary Fund. So good to be with you today, and looking forward. I've had a few weeks away, and I've missed you terribly. Actually, I have had a wonderful and most amazing last few weeks. First of all, we did a beeline boot camp here in Utah. So we had a bunch of our beeline traders come in, and we helped them get through some of those beeline requirements, and we had huge success with that. From that group, we had about 32 traders with us, and from that group, we have had almost 18 of them get funded since that boot camp. So we are so proud of you and the great success you guys have put into the hard work and the good success you put into your trading and into the beeline. Then from there, we left and went out onto a cruise. We went and sailed through the Caribbean, Western Caribbean, stopped at places like Honduras and Cancun and different places like that. Had a great time with some traders on there. We were really trying to explore, really get into the life of a trader. What does it mean to be a trader, and what kind of lifestyle can we really live? And that was great. We'd get up super early in the morning, like at 6 a.m., and we'd do a couple trading sessions, and then we'd go and have fun. They'd go explore different parts of the world, go on a hike, go visit a beach or this or that. So much fun. And then they'd come back and we'd have a nice dinner together and do some training stuff. So we had a wonderful time. Traded our hearts out on that trading cruise. It was so fun. And then last week, my daughter had an opportunity to play in a national soccer tournament, and so I spent a week being a dad and supporting her in her ventures. Great times. So now I'm back, just in time for Thanksgiving. I want to wish you all a happy Thanksgiving. For those of you who are not in the United States or who don't celebrate it, it's a great thing, to take a minute and just reflect on life and all of the great things that have happened and express thanks, look deep into your heart and really recognize the good things that have happened in your life and that will continue. And I think that you'll discover that offering just a little bit of thanks and really reflecting on the goodness in life goes a long way to helping revive your spirit and make you real. You're just a little happier when you do that. So anyway, happy Thanksgiving to everybody coming up tomorrow here in the States. Well, with that, I wanted to take a couple minutes today and talk about a formula. It's not a true formula. But it's a process that we go through. Called the Benjamin formula, and it's something that really helped me in my trading a long time ago. I'll kind of go and give you the backstory. So there was a period in my trading career where things weren't going so well, and that reality check, that famous reality check where you're like, wait a minute, am I good at this, or am I not good at this? Am I doing it right, or am I not doing it right? Well, I had one of those little reality checks in my trading career. I was about 27, 28 years old at the time, and really had an opportunity to reflect back on my trading. And I learned a couple of things through this experience. Number one, I realized that maybe I was approaching trading the wrong way. I'd get up and I'd just be looking for, the best trade setup, and, I'd load into these big trades and throw a lot of resources at it. And, usually, for the most part, they were good setups, and I'd make a lot of money in the process. But by doing that, I kind of gained a false confidence in the market, where if you win a few times, it could be luck that you're winning, or it could be skill that you're winning. And, if you take 3 random trades or 5 random trades and you base your your luck skill dilemma on the performance of those three or four trades or 5 trades, what you'll find is that you can have a misguided sense of confidence, or on the opposite side, lack of confidence, right? And anyway, so I'd built 3 years of this misguided confidence in my trading approach, and this experience gave me a real opportunity. This reality check gave me a real opportunity to go back and explore, some of the go back to the basics and explore some of the real tangible factors that go into your trading success. And I did that. I decided at that time, rather than trying to shoot for, out of the park home runs, I decided I needed to change and really focus on consistency and meeting a specific target every time I got into the market. Rather than having some esoteric number, some esoteric performance level that wasn't real tangible, wasn't real repeatable. It was just happened to be that way, just by randomness, if you will. And so for the next 3 years, I really focused on consistency in accomplishing a specific purpose in the market. And that's what we're going to talk about, is the process, the formula that I used to go through to accomplish my purpose in the market. We call it the Benjamin formula, or I call it the Benjamin formula, because back in the day, it was my purpose, my goal, my objective to make $100 in the market every time I sat down for a trading session. So $100 really doesn't sound like much money. To some people it does, to others it doesn't, but the consistency, the value in making $100 a day is not in the $100, but it's in the consistency of the performance and what you're doing to accomplish or make that $100, if that makes sense. So anyway, I realized that much of my trading was focused on the income side and on the success of the trade setup, and very little of my focus was on the risk side and what it took to, when I made a mistake in the market, what it took to get out of that hole that was dug from my mistake. And so, I went back in and started focusing on consistency and the risk side of the equation. So I want to kind of go through the steps. Before I do that real quick, let's take a quick survey. I'm going to look at the chat box real quick here, and I want you guys to tell me, what is more risky, a stock investment, an option investment, a futures like the S&P or oil or something like that, or currency? So just take a second and type in what you think is the most risky investment: stock, option, futures, currency, something along those lines. And while you're typing that in, I want to show you a trick. If you look at it, a lot of the world looks at risk through that lens. They say, oh, you're a stock trader? Oh, you're so risky. You're taking so much risk. And some will say, oh, yeah, options are so risky. Or others will say currencies, like, how can you ever trade currencies because that's so risky? And the thing that I want you to realize is that risk is not in the instrument. Risk really isn't in the setup. Risk really boils down to how much money you're willing to put into a trade and how much you are willing to risk in the trade. So a successful trader, mark this down, jot this down, whatever you can do to remember this, but a successful trader does not look at risk in terms of what is the market doing to create the risk. A successful trader looks at risk and says, what am I doing to create risk in the market, and how much risk am I really willing to take in the market. Does that make sense? So a trader is completely in control of the risk side of the equation of trading, right? Not the market. The market doesn't control risk. You control the risk. And so one of the first things that you'll, in the Benjamin formula, is that when you find a good setup, when you're getting into the market, you find a good setup, there are three things that you absolutely have to identify in every setup. You have to identify a trigger, what's going to get you into the trade. The second thing is you have to identify a target. You know, where do I expect this thing to go? And where is that target? What is the potential opportunity this market will give me? What's the potential income this market will give me? The third thing is, where am I going to get out if I'm wrong, right? Where are my stops? Where am I going to get out if this thing is absolutely goes against me? So that's what we want to do. We identify a setup. We identify those three levels: the trigger, the target, and the stop. We have to do that before we ever place the trade, right? That's part of our homework, part of our assignment before we get into a trade. Now, the second thing is that you have to ask yourself this question: how much am I willing to lose on this setup? So each trade setup will be a little bit different than the other one, right? The last one you did. This trade setup will be slightly different than the next one. Every trade setup will have a slightly different probability attached to it. So you have to ask yourself, how much, given this setup, how much am I willing to lose if this trade goes bad? If you can calculate that, if you know I'm willing to risk $100, I'm really willing to risk $250, I'm willing to risk $500 on this trade, then it really doesn't matter what you invest in, right? Because no matter what, whether it's a stock, whether it's an option, whether it's a futures contract, whether it's a currency contract, it does not matter what you invest in, because your risk will be exactly the same between all of those different pairs. Now, it may get to your risk tolerance faster in one type of instrument than it does in a stock or in a mutual fund, right? That makes sense. A mutual fund is not going to get to your $500 stop loss as fast as possibly a currency contract or a futures contract. So speed is not risk. That's just how fast the trade executes. But the key, and I can't emphasize this enough, the key is really discovering how much you're going to risk on that trade. So now let's say you've got your setup, right? You've got a good trigger point, you've identified your target point, you've identified your stopping point, you know you're going to risk $250 on this trade, and you're fine with that. You know, you're comfortable with that risk. The next question is how much do I need to put into the trade? Well, most of the work has been done in the setup to help answer that question, right? So what you'll do is let's say that the difference, let's say you're in a stock trade, and the difference between your trigger and your stopping point is $2.50. And then let's say that you're going to risk your max loss on that trade that you're willing to risk is $250, right? Well, the math is easy. It's just you take the $250 and divide it by $2.50, and that gives you about 100 shares. So if every single one of those shares drops down to your stop loss, you're going to lose $250 on that trade, right? It just makes sense. So now you've calculated, you've tuned your trade to your risk and to your particular setup. Now think of the value in that. That's just absolutely awesome, right? And how many people don't tune their trade to the particular setup or to their risk tolerances, right? I think most of us realize that, you know, we have tolerance for risk. Most of us are willing to take a little bit of risk in the market. Where we get in trouble is when we exceed our tolerances, right? And so if we don't go through this process that I just explained, then what's going to happen is you have no idea when you're going to cross your tolerance level. And once you cross that tolerance level, all kinds of bad things start to happen because you're introducing emotions and what ifs and all of that. So important that you tune that trade to, you tune the trade so that you know that you're in the exact amount of that position to stay within your risk tolerance, right? That's a good thing. All right, same thing on a currency pair. Let's say you've got a 25 pip stop loss. Your risk tolerance on the trade is $250. Well, 25 pips times $10 is $250. And so you can basically go with one full contract on that. 250 risk. If you go into one lot and that trade drops down and triggers your stop loss at 25 pips below where you get in, and you have one lot, that's a $250 loss. That keeps you within your risk tolerance, and you've not over-invested. You've not put too much money into that account. Again, just a really good concept to learn, because if you approach all of your trading from that angle, then it doesn't matter what you invest in, what you trade, because every trade that you place will be within your risk tolerances. Now, if you lose one trade after another, after another, after another, that's a whole different type of problem that you have to deal with. Now you've got to go figure out what is wrong with my trade identification. So that's a different problem. But at least you've got the trade tuned to your risk tolerance. Now, the Benjamin formula, this is this is an important next step in this process. So now you've calculated your max position size, right? You've got 100 shares of this stock or one lot in a currency pair. The next thing you do is you calculate the difference between your trigger and your take profit, right? I stand to make 50 pips on this trade, or I stand to make $5 on this trade. Well, now you can calculate it. You take your max position size of 100 shares, multiply that by the $50, and that gives you $5 profit target. Let me get some numbers, better numbers. You got a $5 target in the stock. You have 100 shares, multiply the 100 by the 5, and that gives you $500 worth of income. So now the last step is to say, okay, does my goal of making $100, does this trade put me within striking distance of making the $100 on the trade? Taking the Benjamin goal, make $100 every day or every trade or every session, does this particular trade help me reach my goal of $100 a day? And in that case, the potential of making $500 on the trade is far in excess of the $100 goal or target. Same thing on the currency side. You've got say a 50 pip, or let's say 50 pip target. 50 times 10 is 500. Same scenario. It's almost the exact same trade, right? You can do the math. It's hard to talk and do math when you're at the same time. Any rate, so the idea is that you tune your trade to the risk, right? You calculated where your max position size is, and then you make sure that trade gets you within striking distance of your target or of your daily goal. And then you do that every day. And if let's say that your income potential is less than $100, it's less than your target, well, that's simple. Then you just don't take that trade. That trade won't give you enough money to reach your target, so why are you messing around with it? There's no sense in it, right? You can get more complicated, add time elements to it. This trade's going to take 5 days to reach my target. Well, The target's $500. It's going to take 5 days. That's $100 a day. Again, a good trade. But if it's going to take 10 days, 10 days, $500, 500 divided by 10 is $50. $50 a day isn't going to cut it. So that's a bad trade, right? So again, that's the way that you evaluate. Now, let's go back to my story real quick. This is the process that I went through to create consistency in my trading, okay? Before I went through and before going through this process, every time I sat down to place a trade, before doing that, my performance was random at best and highly subject to an enormous amount of emotion. After going through this process every single day and evaluating, truly evaluating, is this a good trade for me? Now I was able to focus on consistency. And, you know, again, being able to make $100 a day is not a lot of money. But the process, the skill, the talent of being able to make $100 a day, now that's invaluable. You're going to find an enormous amount of success if you have the skill of being able to hit your target every single day in the market. And that, my friends, is what the Benjamin Formula is all about. It's helping you to tune your trades to your risk tolerances. Because if you get out of those, if you're fighting your tolerance, you've already lost the trade. So the Benjamin Formula is helping you tune your trade to your risk tolerance and to your objectives in the market. And it's pretty simple like that. If you want more information, we go into a lot more detail in this, in the process, in the beeline to funding at Apiary Fund. So if you want more information on that, go over to the library in the Apiary Fund, on the Apiary Fund website, and you'll find an entire book dedicated to this process. We also do different classes and trainings on it, so definitely take a minute and get this down, because you want, trust me, you want consistency in the market. You want consistent performance. It is the key. It's the holy grail to your success in the market. So, and this is the best way that I've found to help create that level of consistency. So great being with you folks today. Always enjoy an opportunity to spend some time with you, and again, look forward to your success. All of those of you who are in the beeline, look forward to trading with you in your funded accounts. Want to wish everybody a happy Thanksgiving. Whether you celebrate it or not, it's a great idea, and something that will definitely, if you take some time just to think back on, like I said, on some of the good things that happen in your life. The more time you focus and recognize those good things, the more times they come around and bless your life. So that's take that for what it's worth, and also the Benjamin Formula. I think you'll find some great success in your trading if you start to apply these principles. Thanks everybody, and we will see you next Wednesday. Happy trading.